Good afternoon, everybody. Welcome to our second series of budget seminars for 2021. My name is Mike Hayes. I'm one of the tax partners at Wilkinson Smith, and I'm joined today by Nick Blundell, who's also one of my fellow tax partners, who will be speaking about corporate and business tax a bit later. This webinar is being recorded, and the slides that you're going to see will be distributed by email after the session at some time. If you do have any questions or questions you would like answering, can you please use the Q&A function rather than the chat function, and we'll probably try and pick those up either at the very end of the webinar or at the end of each section. So I'm going to make a start and talk about this budget, and this is what Rishi said it was going to be. It's starting the work of preparing for a new economy post-COVID. Now, clearly, there was a lot of announcements about expenditure, fewer about tax, but some significant ones about tax. And I suspect we haven't heard of the last of the tax changes. But let's see what he was going to talk about. So we're going to split the talk into sort of 3 or 4 main sections. I'm going to start off with some aspects of corporate business tax, then Nick will talk about specific corporate issues, then I'll finish off with personal taxes and 1 or 2 other sort of summary items. So let's get going and go through this. So this is corporate business taxes part 1. One of the things I was hoping for when he announced an increase in corporation tax last year that's going to come into effect from 2 years' time or 18 months' time, more likely, was that actually he wouldn't actually follow it through. But unfortunately, last week, he actually reaffirmed that the corporation tax rate is going to go up to 25% from the 1st of April, and that's for profits over £250,000. If your profits are below £50,000, then the rate remains as it is now at 19%. If your profits fall between those two bands, say they're 150, the marginal rate between 50 and 150,000 pounds is actually 26.5%. So that's a good margin to look at trying to get out of that margin, because you save a little bit more tax, and maybe it might make paying bonuses or incurring additional capital expenditure attractive. Those limits of 50 and 250,000 pounds are divisible by the number of associated companies. So if you're in a group with 3 companies, you divide those limits by 3. On the banking surcharge, the current rate of banking surcharge is 8%. Obviously, he was slightly worried that if he actually adds 8% to 25%, then the banks might get a little unhappy with a combined rate of 33%. So the banking surcharge is actually going to come down to 3% from April 23, which will give a combined rate of 28% compared to the current combined rate of 27%. So hopefully the banks will be a bit happier about that. It's worth asking actually whether we have a competitive tax regime still in the UK. We've prided ourselves on being so. I mean, in his budget speech, Rishi actually said that we have the lowest rate of tax, corporate tax, in the G7 and the 5th lowest rates in the G20. If you look at the International Tax Competitive Index, we did rank a year ago at 22nd overall in the world, which was slightly worse than in 2019. And that was before the announcement of the additional national insurance contributions that were introduced from next year, but brought in from a couple of months ago by Boris. On the positive side, of course, is we do have some very, very generous tax relief. So it does depend on which sector you're in. We have generous R&D, we have very generous creative sector credits, we are opening up our new free ports. So there are some other sides to this, but I do think it's worth, I do think it's something that the Chancellor can't be complacent about in terms of our tax competitiveness. We are still the 8th best place in the world to do business, by the way, so we still rank pretty highly. In terms of corporation tax and the marginal rates of tax, comparing this year with the first year at 25%, clients often want to know, is it more attractive to take money out of a company by salary or dividend? Well, at the moment, if you're a 40 or 45% taxpayer, you get a saving by taking dividends out of about 3 to 4%. When we have the new rate of corporation tax, there's no benefit at all. So it won't matter too much. If you're paying tax at the marginal rate of 26.5%, it's definitely better to pay bonuses. And don't forget, of course, that the choice between salaries and bonuses can affect your gender pay gap reporting, as dividends don't actually count. Moving forward, there were some significant announcements, I think, on creative sector tax credits. The creative sectors have suffered, some more than others, during the lockdown, and obviously it's not unique to the creative sectors. So let's go through those changes. So the first one is for the museums and galleries exhibition relief. Now that was due to come to an end on the 31st of March next year. That's been given, there was an inbuilt sunset clause. That's now been extended to March 2024. Whether it'll go beyond that or not, I don't know, but that's an interesting change for museums and galleries, and we do act for a significant number of those. The government is also going to clarify some of the rules for the reliefs. They didn't say which ones. The press release is very, very sparse. Now, clarify could be good or it could be bad. It could be making it tougher or it could be making it easier. But they do say it's going to make it easier for touring museum and gallery exhibition production companies to claim relief for actual touring, for which they get more tax relief. Perhaps the most significant aspect of this was the increase in the rates for the 3 of the reliefs. So the 3 creative sector reliefs that have been increased or had an increase in rate for the repayable credit are theatre tax relief, orchestra tax relief, and then the museums and galleries relief. So in the first column with numbers, I've given what were the current rates. They're not the current rates now, but what were the rates before budget day? And then in the second column, these are the rates that apply for the rest of the tax year for expenditure from budget day onwards, and also for 2022-23. And then in the third column along is the rate for 23-24. And then it reverts back to the old rates from April 2024 onwards. And as you can see, there are significant increases. So for a theatre, and I'll just run through one of them, if you're a non-touring production, it goes from 20% before budget day to 45% for the next 18 months, then back to 30%, and then back to where it is now at 20%. And then likewise with the touring relief, it's just 5% more across the board. So that is really generous. And no doubt the government are actually hoping that that's going to be enough to get some of these businesses back on a sound footing following all the losses that they've incurred since the lockdown. They think it's going to have a positive impact on 1,200 companies. There's no detail on how you're going to apportion for this year, but I suspect it's going to be some form of time apportionment. And there's no increase in the rates for film, TV, animation, and video games relief. And I suspect the rationale is that those sectors do not require people to actually attend. We're obviously with theatres and orchestras, and for galleries and museums, you do actually need to go in to actually get your income. People need to go in and pay. So they've probably suffered more. And certainly certain aspects of TV production, other things have actually benefited as people have been sort of binge watching their favourite programmes on Netflix, etc., etc. But there's no doubt the lockdown has actually affected some of those sectors because it has been difficult to film during the lockdown. But there has been a constant stream of new product that's come to, particularly to the TV, which brings me on to this. So this is my slide, which just explains what I'm going to talk about next. It's rather gratuitous, I suspect, having Wonder Woman and Black Widow on there, but I'll explain the significance of that in a minute. So one of the things that's happened during lockdown is that certain film productions have gone straight to the internet and to TV rather than actually gone to the cinema. Now, two of those examples that have gone straight to internet have been Black Widow and Wonder Woman 1984. Contrasting with that, you will recall that the latest James Bond film its launch got delayed 2 or 3 times because they really wanted to show it in the cinema. So how is that relevant for the creative sector tax release? Well, the reason is this, is that to qualify for either of these reliefs, there has to be an intention for broadcasting. Now, for film, if you want to actually get the film tax credit, you have to have the intention that it's going to be released to the paying public in a cinema, and that has to be determined at the start of the project and then at the end of each accounting period. For TV programs, you have to have the intention at the beginning only of broadcasting the programs on the TV or internet. So what's actually happened is if you're partway through a film production and there's a decision to actually change where you're going to release this from the cinema to the TV, what happens is you cease to qualify for any further film credits and you don't get any TV credits on your future expenditure, because at the beginning of the project, you had no intention of putting it on broadcasting it for the TV or internet. So what the Chancellor has announced is more flexibility in actually applying this intention test to allow for film and TV programs to have like a change of use, if you see what I mean, partway through the project itself without losing tax relief. And that's going to come into effect from the 1st of April 2022. There are no details as to actually how that's going to work. But hopefully it'll be on a very sensible basis so that you get the relief whichever way you try and actually release the film. So going back to my example here, those were 2 on the left that actually did switch to TV and the internet, whereas the James Bond one didn't. As I recall, Scarlett Johansson, who starred as Black Widow, was not happy with that because presumably she was on a percentage of the take from earnings from the film. And no doubt Disney got less for actually broadcasting it on TV than it going to the cinema, but I think she settled on that. Moving on, let's talk a little bit about self-employed. This is quite important, or what I'm going to say next is quite important. We're partway through the process of this Making Tax Digital, which HMRC are insisting on all taxpayers eventually becoming part of this. At the moment, the VAT is now fully within Making Tax Digital, and we're expecting that self-employed businesses will generally start to come into within the scope of it from April 24, partnerships in 25, so on and so forth for companies. Now, as part of this exercise, what the Revenue have proposed is that for the self-employed, there'll be a change in the way you actually calculate your profits for your self-assessment tax return. Excuse me. So the rules at the moment are that if you look at any particular tax year and you're in business on your own or in partnership, then you're taxed for a particular tax year on the profits in the accounting year ending within that tax year. So for example, if you make your accounts up to 30th of June, if you look at the profits on which you pay tax for the 21-22 tax year, it's the accounts profits for the year ended 30th of June 21, the year ending within the tax year. Now, what is proposed, and this was subject to a consultation earlier in the year, and what's going to change is that we're going to have new rules which fully come into effect from 24-25. And what's going to happen is you're going to base your profits for the 24-25 year on the actual profits incurred within that year. Now, what you will do, if your year end is not 31st of March or 5th of April, what you will need to do is you will need to take the year ended 30th of June 24 in this case, 3 months of which appear in the 24-25 year, and you take 3/12 of those profits. The following accounting year, 9/12 of those profits that are in the 24-25 year, and what you do is you actually add them together, and that will be your assessment for 24-25. In reality, that apportionment would be done on a daily basis, but I've put it on a monthly basis just to keep the numbers a little bit easier. 23-24 is going to be a transitional year. And what happens in the transitional year is that you take the full 12 months ending in that year, so the full profits for the 12 months to the 30th of June 2023, and then you add to that 9/12 of the profits for the year ended 30th of June 24. That's the 9 months that appear in the 2003-24 tax year. And then you deduct your overlap relief. Okay, now what is your overlap relief? Well, when you joined your partnership or you started your business, there would have been an element of profits, in this case 9 months worth, that would have been taxed twice. And what happens is that amount that's taxed twice gets carried forward on your tax return, and you get relief for it normally when you retire or cease your business. So the total assessment for 23-24 is going to be X plus Y minus Z. Now that might sound fine, but one of the problems that gives rise to, using some real numbers, is if you started your business or joined your firm many years ago when profits were much lower, what you will find is that the amount of overlap relief could be completely out of kilter with the level of profits you've got now. So putting some hard numbers on this, so let's assume that in this case, your June year end, your June 23 profits are £120,000. Your June 24 profits are £140,000, and you bring 9/12 of that into the calculation, which is £105,000. And then you deduct your overlap relief. So let's say you started this business in 1999-2000, and your profits at that year were £60,000. 9/12 of that would actually have been taxed twice. So when you add all this together and you add the 120 and the 105, and then deduct your overlap relief, what you could see is your overall assessment is going to be a lot more than your current level of profitability. Excuse me. So that does mean it's something you've got to work out, talk to your accountant and plan for. There are going to be some reliefs from that, but it could be, it could give you a nasty shock if you're not fully prepared. Let's move forward. Now, there is another problem with this. What happens if you prepare your accounts to December? Well, if you go through this and you look at the 24-25 tax year, you're going to actually need your accounts for the year ended December 2025. But your 24-25 tax return has to be filed by the 31st of January 2025. So you're going to need to put in place, and it's very unlikely you're going to have final accounts within 31 days. So you are going to actually have to use estimated amounts and then correct it at a later time, which clearly makes things more complicated. So the rationale for this, well, allegedly simplification. I'm not persuaded by that. It makes making tax digital easier, which it may well do, but I remain to be convinced that making tax digital is going to be good for the taxpayers or for the HMRC by when it's all in place. It does avoid complications at the beginning and end of the business because you're taxed on an actual basis. It is worth noting that the government and the revenue have considered having a mandatory year end of 31st of March. They've gone away from that. But I have to say, I really think that HMRC are really after everyone being pushed towards making your year end 31st of March. They do have behavioural psychologists working in HMRC and other government departments. So I think part of the reason that this is complicated is to say to some people, hope that taxpayers will look at this and say, why don't we change our year into March? It gets rid of all these problems. And they've also thought about changing the tax year completely. And I think that's an ongoing discussion. So I think that was all I was going to talk about. So at this stage, I was going to hand over to Nick, and over to you, Nick.
Thanks, Mike. And just before we move on, should we deal with a couple of questions that have popped up on some of the things you said? Firstly, on creative sector reliefs. I'm not familiar with the theatre, orchestra, etc. reliefs. Presumably this is a benefit to non-charitable organisations as for charitable ones, they would presumably gift aid any profits anyway.
No, I mean, these creative sector tax reliefs are available to charities and also to commercial companies. And obviously most of the companies, certainly when it comes to things like film and TV, are going to be commercial, but museums and orchestras can often be charities. And if the exhibition is run by the charity itself, rather than in a subsidiary company, it does enable, so they wouldn't normally pay tax. You could still claim the repayable credit. So it does work for charities, and we do a number of claims for a number of different charities, both for orchestras and for museums and galleries.
Okay. And then the other question, Mike, before we move on, can you get the overlap relief from HMRC? Might not have it for businesses taken over.
Well, the overlap relief is personal to each individual taxpayer. So if you're a partner in the firm, and I think somewhere on my tax return, it does actually disclose my overlap relief from when I became a partner, whenever it was, how many years ago. So it should be on your tax return. So you should look at your tax return or speak to your accountant. But if not, yeah, try and contact HMRC, I think. But there's probably other places to ask first before you go there. Okay.
Thanks, Mike. Right, and to one of the generous reliefs that you mentioned earlier on, research and development tax relief, and just a reminder of how it works. So if you're an SME, you take an additional 130% tax deduction against your profits for any qualifying R&D expenditure. That generally works out, if you're a taxpayer, around sort of 25% of your spend you get back from HMRC. And if you're a large company, you essentially claim it's a different regime. You claim a cash credit of it's like a grant, 13% of what you spend, which then gets taxed itself. So that works out at around 11%. So it's less generous for large companies than it is for SMEs. But with this being a generous relief, there had been some word that the government was thinking this was getting a bit too generous, and in fact they've already introduced some anti-avoidance measures over the course of the past 12 to 24 months. But in this budget, they did announce a big increase in government spending on R&D, but also some changes to the way that the tax relief will work. We haven't got the detail yet, but they will be expanding some of the things that qualify for R&D relief, to include the things I've mentioned there: cloud computing costs and data set purchase costs. That's really to move with the times. But what a lot of businesses do, I mean, our R&D regime for tax relief in the UK is not territorial. So you can basically have your R&D being done anywhere in the world, and as long as it's managed from the UK and the costs get back to the UK in terms of hitting the UK P&L, you've generally been able to claim R&D tax relief. This is different to many other countries, and what the UK government wants to do is to move to rewarding those who actually carry out their R&D in the UK rather than overseas. We don't know what that's going to look like yet, whether they'll completely stop R&D relief for those who've got their R&D centres overseas, or whether they'll just make it less generous or more generous for those in the UK. But there will be a change coming down the line for those who've got their R&D centres overseas. So that's more detail to come on that, which is probably the biggest change on R&D to come for some time, and we'll get the details soon. Moving on now to capital allowances. If you have the next slide, Mike. So just a reminder of the current rates for capital allowances, the main headline rates: plant and machinery, 18%, special rate pools, so that's things like electrical systems, heating systems, all part of the integral features of the building, long life assets and cars with well, emissions pretty much apart from the least guzzling of guzzling cars or electric cars are in that special rate pool, and 3% on structures and buildings, which used to be 2% and is now 3%. So those are the headline allowance rates. And then if we move on to the super deduction, just on the next slide, That was announced in the spring, so some of you would be familiar with that already, which is basically a temporary relief, a sort of COVID measure to encourage investment in capital expenditure. So between the 1st of April 2021 and the 31st of March 2023, so it's a 2-year relief, allowing 130% upfront first-year allowance for all capital expenditure on new items. So it's new items only. It doesn't apply to sort of acquisition of second-hand fixed assets, and it only applies to companies. So it doesn't apply to partnerships or sole traders. So that was announced in the spring budget. There's no changes to that, but there are some changes. Well, one change to the annual investment allowance, which is on the next slide. And the annual investment allowance, which has a sort of permanent level of 200,000 of what you're allowed to spend each year, where you can get full tax relief straight away. That's been on a temporary increase through to $1 million, which was due to expire on the 31st of December this year. That's been extended also through to the 31st of March 2023 as well, which is the same time that the super deduction is due to expire as well. So for most companies that are buying new assets, you would claim under the super deduction, because you get 130% relief under the super deduction rather than on the annual investment allowance, where you only get 100% relief and is only for the first $1 million, whereas the super deduction is unlimited in terms of how much you spend. So where the annual investment allowance will still be useful for those up to March 2023 broadly is those who are buying not new, so second-hand, or certainly not new expenditure, and those who are not companies, so partnerships and sole traders. So that annual investment allowance has been extended through to the 31st of March 2023, after which time it will revert back to its level of £200,000 per annum. Moving on from capital allowances to the residential property developers tax. So this is a new tax that's coming in for that sector, and only to the biggest property developers. So this comes in. It was announced earlier this year in sort of broad terms, so we knew it was coming, but we've got some more details in the budget last week. Although we haven't actually had the finance bill with all the technical detail yet, and the draft legislation that's coming in the next few days. But from the 1st of April 2022, there'll be a new tax on residential property developers, and it's designed to raise $2 billion to deal with cladding remediation post Grenfell. The government thinks that residential property developers should pay for a lot of this cost, and actually it's arbitrary in the sense that it's not necessarily it's fairly blanket whether you deal in cladding or not as a property developer. You're hit by it if you're over certain thresholds, and that threshold is so it only applies to the biggest or most profitable. So to the extent that your profits from residential property development exceed £25 million per year, you'll then be taxed an additional 4% on top of your sort of general corporate taxation. So we don't know whether it's a sort of levy yet, or whether it's an additional corporate tax rate, sort of 23% instead of the current 19%. We haven't had that detail yet, although we do know it will go through the sort of corporation tax return. It was also due to be temporary for 10 years, but we haven't. That's not in this detail that came in last week. So whether they've decided to drop that and have it open-ended, we don't know. We might find out in the finance bill. But it's a specific levy to raise the money for cladding remediation. Moving on to cross-border group relief. Now, if you go back about 15 or 20 years, Marks and Spencer's put a claim in for group relief from its overseas subsidiaries. Now, those of you who work in a group situation, so sort of more than one UK company, say if you've got 3 or 4 UK companies, will be used to the concept of group relief and sharing losses of one company with the profits of another. and that's our group relief mechanism. Marks and Spencer's thought they'd have a go at claiming the losses of its EU subsidiaries against their UK profits. And to a certain extent, they won that, and that was so the UK government was forced under EU law to introduce legislation to allow companies to claim, under really quite restricted circumstances, to claim losses of EU subsidiaries to set off against its UK profits. Now obviously a government, particularly one that got us through Brexit, isn't particularly keen on this legislation. So now that we've had Brexit, the relief has been abolished from budget day. So there'll be no more EU group relief allowed from budget day onwards. Although anyone with existing claims should continue to pursue the claims, because it hasn't retrospectively abolished the rules. And on to another one that the government wanted to trumpet in Rishi's speech, really from an EU Brexit point of view, is tonnage tax. So this will only apply to you if you're in the shipping industry, in particular the merchant shipping industry. It's essentially an alternative means of taxation. You can elect, instead of being taxed under the normal corporation tax rules, where you're taxed on your profits, you can be taxed instead based on the net tonnage of the ship. And this means of taxation has been around for about 20 years. The government has last week announced sort of significant reform to the tonnage tax rules to make the UK more competitive in a sort of global shipping market. It had effectively also been forced to allow ships that were registered to EU territories to allow themselves to elect into the regime, and it wants to take away that and really promote the use of the tonnage tax regime only for the use of those who are prepared to fly the British ensign on the back of their boats. Moving on to re-domiciliation, and this is another Brexit point, I think, really, because one of the things I've noticed anecdotally is multinational businesses that might want to set up a European headquarters, say in the UK, have started to do that less in the UK, and they've looked more at Ireland, where the tax rate is lower, or to historically friendly countries like the Netherlands or Luxembourg. And this is something that the government have been thinking about, and thinking that this sort of dampening the attractiveness of UK PLC, a bit of what the slide showed earlier around, that Mike showed earlier, around the international competitiveness of the UK amongst its global counterparts. So it wants to promote the possibility of non-UK companies reincorporating or re-domiciling in the UK, and it's issued a consultation to see what people think of that, whether it's a good idea, how to promote its attractiveness, how to promote the availability of it, and so we will see what comes of that, and whether anything can be done, to stem any Brexit tide of businesses from settling in the UK. Moving on, there are a few areas of tax administration that were brought in last week. The economic crime levy, or anti-money laundering levy, the government has decided that those who were regulated by anti-money laundering, so that's people like credit institutions, financial institutions, professional advisors like lawyers, accountants, and us here as tax advisors, gaming, casinos, and so on, that essentially if you kind of want to be part of the club in an industry where you're required to be regulated by anti-money laundering, then you've effectively got to pay a levy to be in it. And this is designed to raise £100 million a year to fund economic crime reforms, and it'll be a fixed fee based on UK revenue. So if you're a small business in that list I've got at the top there, with under 10 million revenue, you won't be caught by this levy. But if your UK revenue is higher than 10.2 million, then you'll be within the levy. And depending on whether you're medium, large, or sort of very large under these rules, you'll pay a sort of sliding scale of amount of revenue on a yearly basis to cover this levy. It's brought in from the 1st of April next year, and then with payments to start to be made from the 1st of April 2023 by reference to the previous year's turnover. The government's also keen to, as well as trying to target those who are actually partaking in tax avoidance, also target the promoters of tax avoidance as well. So it's been doing a lot of this for a good few years now, and this is some additional powers that have been coming in to clamp down on the promoters of tax avoidance. And there's a few areas where they're bringing in specific targeted measures. So they're looking to freeze the promoters' assets in order to secure payment of fines, issue penalties to UK businesses that endorse overseas promoters, issue winding up orders to those that promote tax avoidance, and there'll be a naming and shaming, so a register of those that in their view promote tax avoidance. And this will take effect as soon as the finance bill gets royal assent. The final piece of tax administration is on uncertain tax treatments. Now, this will only apply to the largest businesses and those that don't already have a decent working relationship with the revenue. But there'll be a notification criteria that if you've got, if you've taken a view on something that is uncertain, then you'll need to notify the revenue. Now, what does uncertain mean? It either means that the business has made a provision in its accounts for the uncertainty, for the treatment that they've taken, or that the tax treatment that a business has taken is contrary to a known HMRC position. And that basically means that it's against known HMRC guidance or a known position that HMRC have taken in direct contrast to the position the business has taken. Now, this only applies to the largest businesses, so those with a turnover of over £200 million or a balance sheet assets in excess of £2 billion. And it only really applies where the tax advantage is very big, because there's a de minimis of £5 million of tax advantage in a 12-month period. And just at the bottom, it applies to corporation tax, VAT, and income tax from the 1st of April next year. So it's sort of additional reporting procedure for those who are uncertain on a particular tax treatment or on something. One of the final bits they announced, or the final bit that I've got here, is on online sales tax. If we just go to that slide now, Mike. This was only sort of 3 or 4 lines in their budget document, so we don't have any detail yet, but there is consultation that's going to come down the line. They haven't issued the consultation yet, so we don't see any detail yet on a UK-wide online sales tax. So whether that will be a tax, a levy, in what form it will be for those who make their sales online. We don't know if there'll be a de minimis or anything like that. And the revenues raised from that levy used to reduce the business rates for traditional bricks and mortar high street retailers. So that's really as much detail as we have at the moment, but the government, that's something that the government is considering. Final point I wanted to raise, which is outside of the budget, was really something that happened at the weekend. There's been a lot of talk on global taxation in the last few months, on a global tax framework, and some of you may have seen on Saturday that at the G20 in Rome, before they all verged on Glasgow, there was agreement on a 15% minimum tax rate for multinationals. That's been coming down the line. It was inevitable after lots of discussions and lots of agreement, and countries like Ireland had sort of fallen in on it. Technical details still being worked on, but what that means is we've got introduction from 2023. There are some political hurdles still there. Whether, for example, Joe Biden will get it through the legislative process in the US, we'll wait and see. But that is it from me.
Okay, Nick, we've got a couple of questions for you before we move on, both about the AML levy. First one is, does the 10.5 million exemption level need to be divided by the number of companies in a group, or is it company specific?
It's a good question. I suspect it needs to be divided by the number of companies in a group to sort of get around any sort of avoidance. But we can certainly check on the detail on that, and in terms of what's been announced. I suspect it'll come through in the detail of the finance bill when we have that in the exact legislation.
And a similar question, sort of the similar point, do subsidiaries of professional service companies have a separate assessment AML levy, or is it revenue level, or is the revenue level assessed on the parent? But I suspect we'll find out from that. I can't imagine they're simply going to allow you to have lots of companies and have the same limit per company. So I suspect we need to wait to the finance bill, which is going to be on Thursday, I think.
Yes, I think that's the same point. The finance bill on the 4th of November will give us that answer.
Okay, thank you, Nick. I've got one question that's come through which relates to what I was talking about. Is, could you tell us if there's an advantage changing your tax year now to 31st of March? Well, the answer is it really depends upon the circumstances of your pattern of taxable profits. What I would say is, for example, that if you've got low profits at the moment, perhaps because you're coming out of the pandemic, it might be a good time to sort of change your year end to 31st of March because you might not have such a mismatch between current level of profits and your overlap relief. But you really do need to look at the figures, and you know, if you're a seasonal business, particularly if, say, you're a farmer, but there are other seasonal businesses, you know, you might find that you actually, depending upon your current year end, you know, you could end up with two really good seasons in the year, all in one tax year, by changing your end. So you've got to look at it on a per case basis. So I'm afraid it's bespoke advice, so I can't give you any more than that. So I'm going to just switch my image on, I think, if I can find it. Show self view. Right, so you can see me, which is probably not what you wanted. So I'm going to finish off on personal tax. Not much to say, so I'll be very quick. One thing we knew from the last budget is that all our allowances and income tax rates and bands are all being frozen going forward from 21-22 onwards, maybe for the rest of this parliament. So that's what we're expecting. Nothing changed on capital gains tax rates, inheritance tax rates, ISA limits, lifetime pension allowance, which is frozen now up until April 26. And just to comment on capital gains tax rates, you know, there has been this fear stirred up in the press, but not unreasonably, I think, to say that capital gains tax rates are going to go up. He didn't mention anything this time, so hopefully that means we're okay, perhaps through to April 2023. But I would actually say that you know, it's something that hasn't definitely gone away. So if you are looking to sell an asset or perhaps exit from your business, there may be some merit in trying to do that in the next year or so, whilst tax rates are as they are. Capital gains tax reporting is something that has actually changed if you actually sell residential property and you make a capital gain. They changed the rules a few years ago to say that you had to report the capital gain and pay the tax within 30 days of actually making the disposal. That's actually now been extended to 60 days from budget day onwards, so you get a bit more time to sort it out, which makes it a little bit more sensible. We know from Boris's announcement a couple of months ago that employers' NIC and employees' NIC are all being increased by 1.25% from 2022-23 onwards, and this is to pay for health and social care, although the money is going to the NHS almost exclusively in the first instance. From 23-24, those NIC rates revert to where they are now, but don't get too excited about it because they're then going to introduce a health and social care levy of 1.25%. So calling it a different name obviously makes it a much better for us all. I don't think we're fooled by that one. So just to show you the rates, so the current NIC rates for employees These are the rates on the top line: 12% for the employee, 13.8% from the employer, and those are what they go up to in the second line from 22-23, 1.25% each. And for the self-employed, the top rate is 9%. That goes up to 10.25%, and the rate beyond the limit goes up from 2 to 3.25%. But that increase wasn't just limited to earnings. That increase is also applied to the dividend rate of tax. So the rates of tax for dividends go up from April next year by 1.25% across the board, and I've given you the different rates. So if you're a 45% income taxpayer and you receive a dividend, it's 38.1% tax. At the moment, that goes up to 39.35% tax from next year onwards. That increase was not applied to other elements of investment income, such as rental income and interest. Not that many people receive interest nowadays, but rental income, there was some sort of suggestion that it should be applied to rental income in particular. I think that came from the opposition, but that's not happened. From the 6th of April 2028, the earliest age you can actually access your pension is going to be increased from 55 to 57. So if you're planning to retire in the next few years, you might want to take that into account. You can, of course, access your pension earlier, but there's an income tax penalty if you do so. But there are a couple of exceptions to that. There are circumstances where what's called what you have as an ill health retirement, where you can access your pension earlier without penalty. And that normally is a situation where you can't work anymore. And then there are special cases, normally sports people, where you're allowed to access your pension at a much earlier age. For footballers, it's age 35. So if you want to access your pension earlier without penalty, perhaps think about becoming a professional footballer. And if you're no good at football, you still might find a home at Tottenham at the moment, given the way they're performing, and they don't even have a manager at the moment. So moving on, compliance, just very quickly, a load of money has been allocated, and I won't go through the detail, to actually enable the revenue to focus on increased compliance activities, and also recovering monies under the coronavirus job retention scheme, where there has been some, although the scheme worked really well, there has been some widespread fraud. So there's going to be quite a lot of money devoted to that. And then there's another 292 million being made available over 3 years to tackle the tax evasion and the shadow economy, and to hopefully to bring down the tax gap, which the revenue reckon is 35 billion. It always mystifies me as to how they calculate that figure, because if they know what it is, why don't they go and get it? But I think that's a bit of an estimate. I always think it's a bit high, but maybe I'm wrong. And then finally, just one more thing to go through. So well, actually, I was going to say today is going to be my last budget seminar because I retire next year, but actually I'm doing one this afternoon. So what I thought I'd do as a final slide is just compare the tax rates today with the tax rates when I started in the accounting profession. So that, believe it or not, is going back through to 77, 78. There I was, July 77, a month out of university, 2 months after Liverpool first won the European Cup, and I joined the profession, and these were the tax rates in place at the time. So income tax had a top rate of 83%. If you had investment income, in other words, dividends, interest or rent, then you paid another 15% on top of that, giving you a marginal tax rate of 98%. So you might think the dividends were unattractive, but then the rules actually had something called the closed company apportionment rules, which for smaller companies meant that you were deemed to have paid a dividend even if you hadn't paid one, which actually really did catch you. Capital gains tax was at 30%, as it was for many years. Corporation tax for large companies was 52%, for small companies was 42%. A large company was only one with profits of more than £85,000, so not that large. Capital transfer tax, which eventually became inheritance tax, the tax rate was 40%, which it is now, and VAT was 8%. So the tax regime was much, much different. The Chancellor of the Exchequer at the time was Dennis Healey, was famous for saying, "I'll squeeze the rich until the pips squeaked." What he hadn't appreciated, that the pips largely emigrated and avoided being squeezed altogether. It was a different time, and thankfully we had the Thatcher era, which at least made the tax rate a bit more sensible and certainly not so penal. So thank you very much for listening to today's webinar. I don't think there are any more questions. If you have any questions, please feel free to email Nick or myself. Our contact addresses are on the final slide when you actually get them. We'd be happy. Oh, there's one more question.
So thank you, Mike.
Oh, right. That's not a question. Well, thank you very much. So thank you all very much. As I say, if you've got any questions, please feel free to contact Nick or me or your normal MKS contact. Thank you very much.